Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, November 2nd, 2022. It's 3:20 p.m. Eastern Time. As I'm starting the video, I realize that it's very unlikely to get out to you before the close. I could wait for an end-of-day video, and if anything big changes by the end of the day, I'll either do another video or get you out some individual charts and or post below the comments section in this post. But I just wanted to get this one out because they just wrapped up Powell's press conference, and I'm just going to tell you my takeaway is, and again, this is just a myriad of factors here, but overall I view it as bearish today. I view Powell as pretty much being unwaveringly hawkish. There was some early talks, there was an initial rally, and this is what I'll tell you what, guys. If you're new, believe me, if you take nothing else from it, when I talk about these post-FOMC rips and dips, if nothing else, learn from that. If you reacted to that thinking the initial up was bullish, and this initial down, and look, this could get faded, but this is what I've been saying for years. So these meetings have done this time and time again. You can almost count on, almost bank on, if you wanted a trading strategy, put a little short, whether if you knew which way the initial pop's going to go, you go long, sell the initial pop, then fade it short. But my point being that the initial reaction is often faded and may or may not be the lasting reaction. By lasting reaction, I mean where the market's going in the next few days or weeks. But let me just say this. From a fundamental perspective, I view today's FOMC meeting and Powell's comments as bearish for the market, meaning hawkish on rates. And so therefore, that alone weighs into, I'm going to go over the charts to show you some technical levels, but I think the next move is likely to be down. Now that may change if the technicals change, because there's there are times where you have bearish headlines in the market, bearish news, and then all of a sudden stock prices go up, and there's nothing more bullish than that, because that shows an overwhelming demand for stocks. At that point, it shows you the sellers are washed out, and at least at that point in time there's more buyers than sellers, and ultimately that's what causes a stock or the stock market to go up. More buyers than sellers, it's going to go up. More sellers than buyers, it goes down. It's really that simple. But so fundamentally bearish is what my takeaway is. Even though he mentioned early on the chance of maybe not doing a full 3/4 at the next meeting, maybe doing less, but he made it pretty clear he's going to stay hawkish. So I'm short on the markets, and I'm going to go home short unless anything changes, and that's why I wanted to. Again, I don't know if the video will make it out to you. It's possible if I keep it short enough, but let me just go over the charts. Let's start there. Let me go with the market itself. I think, me, I like the Qs are my primary trading vehicle. The NQ, Nasdaq 100 futures, or I'll refer to it as the Qs or QQQ. I think we're going to see some catch up, or maybe a comparable move to the downside if we do go down from here, as I suspect, in the S&P 500. I think there's some sectors that are primed to fall. Big tech is beat up pretty hard. It's been a great short all year, and again, I'll still like it, and that's what I'm short right now. But I may add some. I added some RTY as well today, and I may add some ES shorts, S&P 500. So one of the reasons among many, this is that bearish rising wedge, which I told you, if you take it on face value, we had a breakdown. I said you'd have to take it with, a grain of salt. But we had a breakdown from the bearish rising wedge, and this is, if you trade mechanically, then you just take these, you go long on these divergent lows, you look for breakouts or bullish reversal patterns and candlesticks, things like that. You short at the divergent highs, long at the lows, short, long, you get it. So you see divergent high down, divergent low up, that kind of stuff. Pretty simple stuff. This is my swing trading time frame, and that's it, and there it is. So today, and look, we just now, as I'm doing the video, we just cracked that 379.74 support right there. I might have tweaked that line a little. It's these recent reaction lows here and that major reaction high right there. So that's it. Sorry, I'm gonna pause the video for one thing real quick. So that's that on SPY. The day is still young. Let me say that again. The day is still young. Sometimes like I said, the initial reaction is faded or, you reverse. Then you get another pop up and another one down. But again, for all the reasons I just said, fundamentally and now technically. So here's what I'm doing right now to make it very clear. I started out by saying my takeaway, again, my interpretation may not be that of the next guy or gal, but it was pretty bearish for the market, hawkish from what Powell said. Now, whether he does, one thing I know about the Fed is he's wrong a lot, and the Fed as a whole, but Chairman Powell as well, and they'll reverse, and I'll bet you we're not going to see another three-quarter at the next meeting if the market does what I think it might do, and that's throw its hissy fit. The market does that when it doesn't get what it wants. It's like a spoiled child, and it'll go down, and then again, now here's the thing: we have a long time till the December meeting, so it's not as if the Fed's going to come in and they can make some comments at their speeches in between now and then, but the market's really going to have to take Powell on his word now, and that's a long way away. So seasonality, everything else, here we go. I think we could have a nice down from here in the market. So that's the S&P 500 on SPY. Here's QQQ. I give you these levels right back here. We've been, all these purple lines are levels, but that was one that was there a couple weeks ago. 269. 269 even. It was to me a pretty significant level. Why? Well, I'll show you. You have a reaction right here. Let me circle these. There was a reaction low. Briefly popped it and then rallied off it. Broke it there and went down pretty far, tried to back test. There's been a lot of volatility. So you've come through here a few times, but just, if you eyeball it, there's been a lot of reactions on around that level, and we're cracking it right now. And, I've kind of warned before. I've warned it back here, and I've been warning it, and I showed you the analog to 2008. The possibility, not a whole lot has changed in the last few weeks when I told you things like the VIX ready to pop, still not where it's never hit that end of the bear market level. Last two real bear markets, 36% drop in the S&P 500 was right here. That was the spike into the March lows and when COVID hit, and that was the bear market back, the last bear market, 2007 to 2009, and that was that surge into the 2008 lows, and it was followed by a slightly lower low right here in '09. But either way, that is one of several indicators that I use to tell me, hey, there's a good chance the bear market's over, or at least this leg of the bear market. So, like I said, I've heard it on this site, and I've heard it a lot on TV and stuff, talking about all the excessive bearishness in the polls. But I told you that's one thing I've learned years ago. The IIAA poll, which is the main bull bear sentiment poll, that's in rhetoric, not action. I find the put to call ratios and the VIX much more reliable because that's where people are putting their money, where their mouth is. They're laying bets on puts and calls. And I don't have it up here, but I've showed you that before. My put to call ratio is not signaled to bottom yet in the market. And so, excuse me. So, anywho, that's one of the things I'll be looking for there. We still have this uptrend line. VIX has been steadily walking higher for the last few years now. Pretty good resistance there around 36, 37, then around 50, and then again, that's if you get that spike there, and you're at a nice support level, or you have other signs of reversal, whether it's a selling climax, with volume and a big surge down, or a candlestick reversal pattern, maybe divergences, maybe not. Those are all things I'll look for a more lasting bottom. When I say a lasting bottom, the kind of bottom I'm going to take 401k funds that you can't actively trade in and out and move that back into the stock market into a sizable chunk in equities right now. Still sitting tight with pretty much mostly bonds. And I'm just speaking to that because that might speak to the group better. Well, majority of my accounts are, even my IRAs, including traditional SEPs and things like that. I can invest in anything I want. I can even short because I trade mainly futures, and you're allowed to short futures, at least with Interactive Brokers. I'll let you short those. 401ks, I use that because I know a lot of people listen to my voice don't have the skill set or the ability to short in accounts, and a thing like that. Well, you have three choices really: stocks, bonds, or cash. You can get your U.S. equity funds, international equities, small, mid, large, if you want to get fancy with it. Or you have a couple bond funds, and then that's usually it. That or a money market account, or what's called a stable value fund. So, like I said, we're in a bear market, and sometimes if you don't have the ability to have trade commodities and other things in there, then the best thing to do is stay mostly in cash. Or at this point in time, again, there may be more downside in bonds. We didn't certainly get what I wanted to hear, and we didn't get the breakout yet in TLT. I covered that in the previous video, so it's still not that all-in moment, but the risk-reward is much more attractive for the reasons I stated before earlier today, both from a fundamental and technical perspective. It seems to me the downside is relatively minor. It's much more smaller than the stock market, and I think the upside potential is a little better. And again, you're going to have a lot of, I believe, a lot of institutional investors starting to nibble now that you've got yields up above 4%. Yes, still below what they tell us the rate of inflation is now, but the thing about Powell, and I listen to him and I watch, and the one thing in the press conference that just drives me crazy, nobody asked him directly about. There was one comment that kind of alluded to risk elsewhere in other countries, but it wasn't, I didn't hear anything about his concerns about systemic risk here in the U.S. For example, I've been warning about, the pension funds, even endowment funds. I just read an article the other day about the endowment funds for the major universities, Harvard and the likes of those, and how their performance figures are, to me, suspicious or skeptical, I am to say the least, when they reported their recent performance. And that is because, just like these pension funds, they've shifted a lot of money into private equity. And private equity pretty much gets to market. They get to value their assets for what they believe is fair market value. They do have different metrics they do. They can't just completely make up a number, but it is a very lagged thing. And that was, and they're all citing that's what buoyed their performance, and they were down, most of them, but down a whole lot less in the market. And they used to run, the old 60-40 model, and I think he was even, maybe it was Harvard. One of their the head of their endowment did say they were concerned about potential markdowns in private equity portion there, because of those reasons I state. That's going to be. So where I'm going, I sound like I'm rambling, but these things weren't brought up to Powell. So Powell's continuing to stay on this path. We're already at, and we've seen it again. I was warning about things breaking months ago, and they've already started to break. We saw that in the UK recently with the gilt market and their public pension funds, which were loaded up on gilts. And therefore we've seen a lot. We've seen a prime minister come in and 6-7 weeks later gone. That was a record there. So these things are happening, and I didn't hear that addressed here. And Powell, he's hell-bent and cross-eyed to put an end to inflation, and pretty much, I think, is ignoring the risks. He acknowledges a slowdown. I think this is where what I'm trying to say here is Powell acknowledges, and he even was asked and acknowledged, he thinks the risks of a soft landing are lower now than they were before. In other words, he's pretty much acknowledging, yeah, I'm probably going to tip the economy into a recession, but nobody's speaking about the risk of a major crash type scenario. Some big black swan. It wouldn't even be a black swan. Black swans come out of nowhere. I'm not the only one talking about this now. And so again, this is where I think the risks are right now. Yeah, the market can rally if it can hold up and get back above those levels that I showed you earlier, and I'll go over again here today. But if not, we go down, we start spiraling down, that's where things are very likely to break. And then what he just doesn't get, it happens fast. And this is kind of, I guess, what I'm trying to drive home. These things happen fast. They happened fast in 2008 when things started to break in the financial system. You got the waterfall selling, and it is a domino effect. And nothing is more. This is, he's trying to figure out which indicators to use. He's being dismissive of other ones. Somebody asked about the short-term yield curve inversion, which is about to occur, and he's just being dismissive now of things that they used to put a lot of weighting into. This right here, I've told you before all along, DJP is one of my real-time inflation indicators. It's a broad-based commodity index ETF, and it's been going up, 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 up. This is the inflation Powell didn't see. This is an abatement we've had recently, but again, as I mentioned, I'm starting to go back into several commodities long again. This is a correction, I believe, in an ongoing bull market. So that's one indicator that I look at. It's my real-time inflation indicator. I'm hearing about the housing markets. It doesn't take a rocket scientist to tell you that we just hit over 7% mortgages, and that we're going to see a sharp decline, and numbers are finally coming in the housing market I'm referring to now. And now keep in mind that data is very lagged. It takes a while between when the sales numbers come in, you start to see home prices dropping because they have to have that transaction. But we're already seeing a lot of cancellations and things like that, a huge plummet in mortgage refi. So it's all there. All I'm trying to say is, that's known information, but it can really start to snowball here, and will likely, because of the other indicator, I don't talk about it as much, it's sort of a given, is this right here. Okay, so the one pillar, the one, maybe you want to call it one of the thorns in Powell's side, is the consumer, and he cited it today. The consumer's still strong. They're still flush. We've got a lot of cash, and consumer spending, as he even acknowledged, is holding up. Okay, well, I've been doing this a long time, and there are two things. We all know this. The two biggest drivers of consumer sentiment are the stock market, because that's the value of your 401k, your savings, your portfolio, and the housing market. Okay, so we know what the stock market's done. We know a lot of people. I can say yes, okay, the S&P 500. We can look at the QQQ. It's tech heavy, and we can say, all right, most people are going to be diversified a little better than that in the S&P 500. So that fell from top to bottom about 27%, and we're off those lows, so we're down about 20% now. But there's two components that I look at, and I know I'm kind of all over the place here, but when I'm trying to figure when is the consumer really going to break and roll over, there are two components to this. Number one is the amount of the drop. How much, where's that pain number? And it's different for everybody, and it's cumulative, but I think at some point there's this sort of, again, I used the word a few months back, a paradigm shift, where you kind of get that, and all of a sudden, or a tipping point, if you will, with consumer sentiment. And, only time will tell where that number is. Yes, we know the consumer is more flush, are very flush now from all the excessive stimulus the government pumped out after COVID. But so how far down we go is one thing. But if not more important, the other component is time. Now, and here's a great example. When COVID hit, if you blinked, let's say you were, you live in a cabin in the woods, you don't watch the news, you don't turn on the TV. I mean, it was there. Most people knew what was going on. But my point is this, that it was down from top to bottom. That whole 36% or so drop was about 6 weeks long, I believe it was. Maybe not even. No, let me grab it again here. We went down. We peaked. Where was it? Right here, in the end of February, and and it was almost not even the end of March, so less than 1 month, about 3 weeks. So there was a 36% bear market over in 3 weeks. Well, here's the thing. Most people, the majority of people out there that are not active traders like you or I, that are checking our accounts minute by minute, day by day, they get quarterly statements on their 401k. So if they didn't know, or they didn't open up their statements, they didn't get it until after, well, guess what? They were back here. They didn't even see that loss. But when you have a persistent, slower, this is how I figured this one would play out. It's been a slower grind bear market. You start to get those quarterly statements. They come in here, they come in here, they come in here, and then gradually you get that sentiment shift where the consumer starts tucking the shell. So we're already pretty, this one's getting pretty long in the tooth. I know there's a lot of folks, and I said the cases there, maybe a bottom right here, a tradable bottom, but not the bottom. And so that was, we were about 9.4 months into it. And I'm going on the S&P 500. Remember, the NASDAQ topped even earlier, topped back in November, the S&P in the beginning of the year. So here we are now. So I guess what I'm trying to say, if we have another leg down, instead of being, at 9.4 months, we were at the low. We've had a little recovery. I'm sure everyone's looking at that, cheering, seeing their account go up in the last few weeks, 10% plus. But now if we have another leg down, well, we're going to be almost a year into it by the time that leg hits. If I turn on my next targets, right here, we're probably coming down to 341 at least. We'll probably visit that level right there. It's a support level I have on the S&P, QQQ, same thing, 237 or so. And you get down there, and now it's going to be a domino effect. You're going to have more and more people that maybe were holding their breath here, putting their head in the sand, thinking the worst is over. You get more and more people capitulate, and that's the one thing lacking in this bear market, and that's why I've never waffled on the fact that I don't think it's over yet. It's just a matter of recently, hey, we're going to have a decent rally. Hey, that case is still there, by the way. Today is just Fed day. It's down. We're down now 2.6%. We still have a divergent low, big positive, aka bullish divergence on the daily and weekly charts right now. They're still very much intact. However, if we go down, we take out those lows, especially if we take out those divergences, that's going to be very bearish, and I don't think we're going to continue to fall in such an orderly fashion. I think you could have a big leg down. You may even overshoot my next targets, because I've made it pretty clear, and I try to revisit this from time to time, that this next target, T4 around 235, 236, is just what I call my initial bear market target. I think we've probably embarked on a secular bear market in equities comparable to what Japan had back starting in the 90s. And so within that, there are going to be some cyclical bull and bear markets. Now, being that this is not my final ultimate bear market target, it's possible we slice through it. First things first, guys. I don't want to come across as too bearish right now, because the day is very young, the week is young, but I wanted to get the video out and tell you that as of now, I took as what Powell said to be bearish, and I'm going to just reiterate it here in a second, go over those charts I already gave you. The price action today is bearish. Take it with a little grain of salt, but a little smaller grain as the day goes on. A little less of a grain tomorrow, and certainly by next week we can forget it. No more grains of salt. If we're below support, take it on face value, because the Fed meeting is now out of the way, peak earnings are out of the way, and the market is free to do what it's going to do. So look at where we're at right now. And the Q's 268.30, that was a big level I laid out in the beginning of the year. These targets, that was my third target. We hit it there back in mid-June. We bounced as expected at the time. We hit it again here, had a little bounce, had a little whipsaw, started to rally off it, but look, we're back at it right now. We're testing it. So this is a big level. It was back then. It was a big level to me here. It was still a big level to me there, and it still is right now. So if we go much below it, that's not good. It's going to do several things, including foil these potential divergences, and then we're going to have so far tracking very similar to how the bear market was back in 2008. So we'll see, and that's it. It's do or die. So let me give you these levels to watch. 269, we're below it now. More importantly, on the daily chart, well, there's the previous low. Yeah, 269.28. See, that was that previous low. So here's how I think. Here's how my mind works in technical analysis. That was a major reaction low. We hit it. It was support. As expected, we bounced. I posted covering all my shorts there, the last of my shorts, and going long, starting to skim the longs. For the bounce, I laid out a target zone up here. Bounce target zone, got short again. Then we hit it again. We had the whipsaw and we bounced. That was, as I said at the time, bullish. and it should have been, but right now we already had test, whipsaw, started to rally, and we're back here again. So that's not very good. It's just showing a bull trap, I'm sorry, a bear trap like that should have been the catalyst for a much stronger advance. Now it's not over yet, but the fact that we're just hugging this line, get a couple weak bounces. You can see these two bounces, by the way, both of them after hitting it right here. Remember that one? Right here. I'm trying to get my circle tool. There we go. There we bounced to that level, about 284 and change. Then we had the recovery. We rallied up to that, got rejected off that level, and now we're back here. So being that there's been so much consolidation around here, I think if we can't reverse soon, we're going to have a big leg down. This is like you're going to see these 3, 4, maybe even 5% down days in the next week or so. Likewise, if the bulls can save it here and step in and start buying it up, but like I said, they pretty banged up today. When you look at, let me go to a different board, or let me turn off all these. See this purple trend line here? Let me show you right here. Look at that. We're back testing that now again. So this is we already broke it here. We broke it there, back tested once. Sorry, I know there's so many lines on this chart. I'm going to try to clean it up for you. There's the trend line. That was our breakout. Rallied, back tested, they bought, but they've been so far. Now we had the makings of an uptrend, higher highs and higher lows. Now we so far have the makings of a new downtrend, and we're back testing again. So bulls, pretty much, I see it. It's not a hard line in the sand, but this is where do or die. They need to come in now, take that out, rally it. I don't think they're going to, or I wouldn't be short, obviously. And if they do, guess what? I'm going to cover my shorts. I'll probably lose some money on those, and then I'll decide whether to get long or not, and I'll try to let you know when that happens. But right now, I've already stopped the video twice to layer into more shorts, and I might do it again before it's over. I just want to finish up, give you these levels, and get the video out to you. And yeah, looking at the clock, unfortunately, it'll be after the close today, but again, I don't think anything's going to change now. We've got about 13 minutes to the close. There's a wedge, there's a breakdown. We're starting to build momentum to the downside. Plenty of support in the S&P 500. Remember, the S&P has been stronger than the NASDAQ, so it does have a lot of support. It's got a little more cushion, if you will. And when you look at the NASDAQ 100, so this may just be some post-Fed selling. It may be sucking in some shorts, clearing out the last of the weak-handed longs. If we do bounce, guys, if we do reverse, these are still potential targets. The downtrend line off the all-time highs in the S&P 500, and that comes in around the 200-day moving averages. So that would be your bullish scenario, and they need to hold it here. What would cause them to hold it? Well, you do have. I'm going to go to the 60-minute charts of the FAANGs, and I'll wrap this up. Apple had a trend line, but it just broke. That's not good. Microsoft had some divergence here. I was going to show you in the beginning of the video, and I'm going to draw the line down, drag it down. We still have divergence, but if we go much lower, remember, divergence is not a buy signal, and this divergence is not confirmed. But if Microsoft can reverse on or around that previous low and start to rally up, and especially if it can confirm this bullish divergence, well, then there it is. Maybe you do get a rally. So you have a lot of potential divergence in these FAANGs. This is Alphabet, Class A shares, GOGL. So if we can rally, probably not going to be much today. It'd have to be overnight in the futures and or tomorrow or into next week. Otherwise, I'm starting to see some of these divergences get taken out. And here's the thing too. 60-minute chart, yeah, there's a case. If we can rally soon, turn around. But when I look at the weekly chart, let me show you this. The weekly chart, well, Apple's been the strongest of the lot. We all know that. Microsoft, look what's going on now. You're starting to see these divergences. This one's getting taken out. See that? You now have lower lows in the PPO there. I don't know why the bottom of the chart is cut off. Let me try to fix that. There it is. So you still have some RSI divergence, but no more PPO divergence on the weekly. And that's just one. Remember, Apple, we never even had divergence because it never made a newer low recently. Alphabet, same thing. Look. Remember, this is 2008, but you're getting a little X-ray shot of it here. So it hasn't yet happened on the indexes. By that, I mean the weekly divergences haven't yet been negated, but they are now negated on so far two of the giant big FAANG stocks, Microsoft and Alphabet, right there. I'm showing you, at least on the PPO. And then Alphabet, that's the other share class, GOG. And then Tesla, you still have potential divergence. But again, when you start seeing some of those break those divergences, take them out, usually you see the rest take it out. That's my experience. And then I look at other things that have held up, and really that's why the Dow has been super strong, stronger than the S&P. You have a lot of names like UNH going down here. These are S&P 500 components. Big divergence. So this one just hasn't broke yet. So that's why I think the S&P, ExxonMobil, I'm putting a short on the energy sector today. I'm seeing breakdowns in the leader, XOM, and pretty much the energy sector is these two stocks right here, Chevron and Exxon. And they both broke beautiful trend lines. So they're hard shorts right now, in my opinion, especially if you are bullish and you want to hedge. This sector right now has the most bang for your buck. I really like the energy sector. You can short XLE, is just really over 50% Exxon and Chevron. Big red candle today. If you want more juice, you can go with XOP. XOP is the exploration and production ETF. It does have also those two, Chevron and Exxon, but also other companies. And it has a higher beta. It tends to fall more or go up more than XLE. And then XES is even more higher beta. Usually it tends to fall, rise more. So this is my favorite short sector right now, the energy sector. And again, there are variations of these ETFs, whether they're leveraged, non-leveraged, or inverse. You pick. There's too many for me to list right now. And that's it. So I'm going to get the video out to you guys. It'll probably come out to you right after the closing bell. Sorry about that. I had to wait and see how the dust settled. But again, if that's not a lesson to be learned there, if you got whipped out today of any positions or jumped in, this is typical. It's almost you can bank on. You can't always know which way it's going to go, but you know there's going to be this up, down. Those are huge spikes, and then boom, this is where the market decided to go. So right now, because of my interpretation of Powell today, being hawkish, and more importantly, the technicals. Because even if the technicals told me to be long, I'd be long right now. And I may be long tomorrow. And if I am, I'll let you know if something changes. But I gave you levels to watch. And those are the things that would make me change in my mind. Like that bearish rising wedge breakdown in SPY, for example. Well, broke down. Now if we go up well above there, back above that trend line especially, yeah, that's going to be bullish. And then guess what? This was the whipsaw, and they got me. As of now, I'm short. This has been Randy Finney with Right Side of the Chart. Have a great day.